Somebody who's like me, a tax strategist, what we think about is how do I help this client pay less tax? What can we do during the year? Tax planning doesn't happen in March. Tax planning happens before the year is over, because once the year is over, for this year, there's nothing I can do for you.
The number one thing that real estate investors want to take advantage of, but usually do not do right. That's what we're going to be talking about today on the Lady Landlords Podcast. I am joined by Tatiana, and we're going to be talking all about tax strategy for real estate investors. Tatiana, thank you very much for being here today. How you doing?
I'm doing great. Thanks so much for having me on. I'm excited to be here.
Yes, you are my personal tax strategist, CPA, and the person that does my books for my real estate portfolio. And I think it's really important whenever I find somebody that has just been such a huge asset to my business to be able to share those with other people. And you have taught me so much in the time that we've already been working together. So I am really excited to dive into a lot of these topics that we get so many questions about in the Lady Landlords Facebook group. But first, why don't you just introduce yourself, the woman behind the CPA and the tax strategy and all that stuff?
Absolutely. I've been an accountant for the last 20 years, but I'm a very different accountant from everybody because I actually love life more than I love accounting, if that's possible. But I have two kids, I have a family, and the family always comes first. Actually, scratch that. My personal health and well-being comes first, because if I'm not well, then I can't be there for my family. Then family comes second, and then everything else after that. I have two kids. They're 12 and 9. I have a great husband. We have a great family, and we really love where we live. We live in Bedford, New York, and we really enjoy life. Some of our probably most fun times that we spend together is doing nothing in front of a TV, or just like everybody's doing their own device or whatever. I love ballroom dancing. I go to take salsa, bachata, West Coast swing classes at least once a week, which I really love, and everything between, and read a lot, and travel, ski, and all kinds of things.
That's awesome. We're going to have to plan a double date here for bachata dancing. So since you are not that far from me in the New York area too, that is something that we'll have to get Emilio or myself to come out and join you guys. I could use some classes in my bachata for sure before I go back to the Dominican Republic. So, but yeah, we'll have to get that planned. But I love what you said about really making sure that your personal health and well-being kind of comes first, right? I feel like as women, we tend to not be able to put that first. We're always the ones taking care and helping everybody else. But it's really great to be able to say like, hey, I need to do the things that are for me first. So that way I can actually be better at being there for everybody else. Is that something that you realized kind of from the beginning, that you had to make sure to take care of yourself first for the others? Or was that something you kind of learned along the way here?
Kind of learned, along the way. I think for many years I've put work first, and it's true for many accountants. Generally speaking, accountants love what they do, love numbers, and generally speaking, to be a great accountant, just as a general rule, you really need to have that introverted, slightly sociopath personality. But it's true. Like, you don't like to talk to people, you're hiding behind the screen kind of, and that's just the reality. What makes a good accountant makes usually a terrible manager for that reason. So for many, many years, I've put work before everything else, before my own health, completely neglected my body, got an autoimmune condition that is now completely controlled, but
Wow.
but I still could have avoided doing that. Let's put it this way. And I'm a forever student. I keep learning and reading and doing all these things because I have done that all the time. Like, I think of our energy as a cup. And if there's nothing in that cup, then you can't give to
Right.
other people. So it's actually not selfish. It's actually, with guilt and all of these different things, it's actually a good thing when you take the time and prioritize filling your own cup before you can give to others, because selflessness is just doesn't work. I feel like it's almost like a waste of life. You were
Yeah.
brought onto this earth to create something beautiful, to create something better, or whatever. And so I think that when you pay attention to yourself first, that's what makes a difference in the world.
Right. And I think once again, it's helps support the others around you even in a better fashion. So I love that you did that. I know that's something that there is someone else listening out here in our virtual world here that I know that mean a lot to. So thank you for sharing that. But being an accountant, yes, usually when people think of, outgoing, extroverted, charismatic people, accountants are usually not the top of that list there. Was becoming an accountant something you always wanted to do, or what kind of drew you into that field in general?
It's actually a cool story. I mean, maybe not cool for somebody who's not in it, but I think it's a cool story. I actually wanted to be a lawyer for since I was 14. And back in Belarus, where I'm from, I even went to law school for about 2 years, which is, in Belarus, it's a 5-year program. You basically have to pick your profession when you're like 16, because you're not going for a liberal arts degree like you do in the US. You go in to a law school or to an engineering school or whatever. Like you pick your profession before you even get a chance to try any of those things or figure out what you want to do.
Or can drive? Like, I mean, 14,
Correct.
that is very, very young. Yeah.
Yeah. So I was excited about law. And when I came to the US, I came after 2 years of law school. I was getting my paperwork done and stuff. And so I couldn't go back to school for a few years. And what I realized was that here it's a graduate degree. So you first need to go and complete your bachelor's.
Yeah. Not just from 8th grade to law school. Yes, that is not the typical route here in the States.
Yeah. So I had to go. So I transferred some credits. When the time came to pick a major in college, I chose accounting because I was already working as a bookkeeper. It was a brand new field for me. Had no idea, like I didn't know what it was about. And I picked it because I was already working as a bookkeeper and I had to support myself. And I thought, if I were to continue to support myself financially through college, then through law school, then I need a profession that's a skill. And accounting is a
Mhm.
skill. Engineering is a skill. Architecture is a skill. All of these different things are skills that you can always make money with.
Right.
So that's why I picked accounting. And then I got lucky because in college, I went to Hunter College. It's part of the CUNY system. And we got some of the best instructors, some of the best professors who really loved their fields. And what was really amazing about them is that they brainwashed us. At least they brainwashed me. I don't know about others, but they brainwashed me. They would always say, if you're majoring in accounting, you might as well sit for the CPA exam. And I thought, I might as well. And so that's kind of how that happened. And then because I was also working in bookkeeping at the same time, I mean, we're talking 2005, 2006, I was learning stuff at night in college and then applying it next day at work. So for me, it was an instant connection of theory and practice. And that's what made accounting alive for me. So after I've graduated with an accounting degree, I abandoned my law pursuit and just stayed an accountant because I really fell in love with numbers and fell in love with small businesses because I got to change people's lives every day with my work.
Right. And I love the fact that also you're saying that those were things that you were able to put into practice like the following day, right? And really kind of see that impact immediately, which really makes a big difference. So now you ended up becoming a CPA, right? And now you have the bookkeeping background. What had you then go and now have your own firm and then also be a person that's known for really supporting those in real estate specifically?
While I was going to college, I also had to support myself financially. So I ran my own little bookkeeping business. I was doing accounting for small businesses, about 5 or 6 of them, because when the first year I went to college, I was able to go back to college. Let's put it this way. It wasn't my first year in college, but the first year I worked full time. And then the second year I needed to take on more classes in my job, my full-time job at the time. It was a plumbing company. They didn't want me to like 2 days a week to leave early or come in late for classes. So I was like, okay, maybe that's not meant to be. So I left the job and found 5 or 6 different businesses who needed like me for a day or for 2 days a week or whatever. And so for half a day. And so I've been basically running my own schedule for 3 years. Made Dean's List every semester because if you want something done, give it to the busiest person, right? So I was busy, but I
Right.
was getting stuff done. And so when the time came when I graduated in January of 2009, when the world came to a halt, an economic halt. That was the subprime mortgage bubble burst, if you will. And I decided, you know what, I still have some clients, I still have work to do. I'm gonna take this time. And accounting firms were on a hiring freeze. And it's actually
Hmm.
good because I didn't end up going to a large firm, because in a large firm, I would never learn the nitty-gritty of the work. I would learn one piece of a large process,
Right.
and I'd be really good at that piece, but then nothing else. So for about a year, I ran my own show again. and
Mhm.
was studying for the exam. And then by the end of that year, I found a job at a small firm where I got to do all kinds of things hands on the first day. And about 6 months into it, even though it was amazing experience, it was a great firm, a great just overall experience, not just personally, but also professionally, I realized that I am just not a bird that is meant to be caged. And that's it. So about 2.5 years after I left, and I also got pregnant. So I figured, you know what? I don't want the traditional path. I don't want the traditional path of not raising my own kids, of working in accounting. I don't want that. And so I left when I got pregnant,
Mhm.
and I knew I was going to start my own thing again. And that's what I did.
Right. And that also allows you to kind of have that control over it, right? I mean, maternity leave in America, I mean, that's a conversation for another day, but that's also, very limited from a financial perspective, from a time perspective, all those things. So really having your own business kind of allowed you some flexibility within that. So that's awesome. One of the biggest questions we get about accountants or tax strategists is how do you know when an accountant is a good accountant, right? So people will go and be like, okay, time's coming up. I need to start thinking about who's going to be doing my taxes in the new year. Usually around February, we start to get a lot of questions, or March. My favorite is on, April 14th. Hey, how do I find an accountant? Right? Got to get my taxes done. So could you just give us maybe a couple things that maybe we should be asking accountants to, one, find out if they are the right person for us? Like, what's the difference between one accountant versus the other?
There could be a whole episode on this topic, but I'll give you kind of the snippets, the kind of the insights into it. Let me back up for a second. In America, you don't have to have a license or degree to do taxes or to do bookkeeping. And because of that, naturally, there is a lot of people who don't actually know what they're doing. And you as a business owner, you as a real estate investor, you as a human being don't actually know whether or not they're doing the right work for you. And so typically because of that, I always say, start with someone who's licensed, whether it's a CPA or an EA, which I can explain the difference. It doesn't matter as much when it comes to tax work. It does differ in terms of accounting work. And I'll explain in a second. But you want somebody who's licensed because you want someone who is afraid to lose something. Someone
Yeah.
who's afraid to lose a license, not does the due diligence and puts his or her license on the line. And so that's the first step. You want somebody who has license, and I would verify the license. CPA license in every state, you can verify it on the Department of Education website. You can check if somebody has a CPA license. EA is slightly different. I think there is a database of EAs on the IRS website, but
What
I'm
does
not
that stand
100%.
for?
It
EA.
stands for enrolled agent.
Okay.
So the difference between the two, CPAs are certified public accountants. EAs in many states can't even call themselves accountants because in order to be called an accountant in certain states like California, for example, you have to have a CPA. EA is an IRS license. It's an IRS exam, and it's specifically tax focused. There are three parts to the EA. That's individual tax, corporate tax, and partnership tax. And you have to pass the three parts or whatever, but it's heavily tax focused. It's not necessarily accounting focused. So people who can do taxes well may not necessarily understand the journal entry behind every scenario. And sometimes that's where they get in trouble or their clients get in trouble. Generally
Hmm.
speaking, EAs are pretty good with tax
Okay.
disclosures, reporting the numbers, making sure everything looks right, all of that jazz. But when it comes to journal entries, and maybe like the biggest part of a business tax return is not putting numbers into a program, it's actually closing the year, making adjustments, making different other things. That's the biggest thing. And often they may not have the experience to do that properly. Some do, some don't. Some maybe went to college, got an accounting degree, but couldn't pass the CPA, took an EA instead. They
Hmm.
may understand the basics in accounting, but those who just became an EA to earn a few extra bucks, that's a different story.
Okay. So it really sounds like the credentialing is very important to ask a person, like, what are they actually licensed, or what do they have the credentials to do? Where are they kind of in this food chain? It almost sounds like.
Correct. Correct.
Okay.
I personally would not, and I'm not saying unlicensed people don't know what they're doing. Sometimes they do, sometimes they don't. But I would not personally go to somebody who doesn't have a license to work on, especially business return. Bookkeepers is a whole other dimension because I actually train people to become bookkeepers. And the reason I started is because I couldn't hire people that were not up to my standards of bookkeeping. Because I started out as a bookkeeper. I started out in the trenches of business,
Mhm.
which is basically accounting 101. That's what bookkeeping is all about. Many people think that learning QuickBooks or another software makes them a bookkeeper, but it doesn't.
Right,
And so often what happens is that you won't be able to tell whether the work done for you makes sense.
right,
And so you have to kind of probe and ask some questions and make sure that you understand, because when you sign your tax return, the problem is that it's your responsibility. You sign it under penalties of perjury. Every tax return says that. I certify that this is true and correct to the best of my knowledge. And so it's not really the preparer's liability if something is wrong. It's actually up to you to notice that. Unfortunately, we don't have enough public education to be able to spot the wrongdoing, if you will. So I would say look for the balance sheet on a business return. That's a good one, because bad preparers typically don't force a balance sheet when you don't have to. Good preparers force it whether they have to or not.
right.
Um, Look for the proper, especially for real estate professionals. If you have a separate reporting entity, so an S corp or a partnership, look for what the basis is of your property. Let's say you just purchased. How was it recorded? Is it correct? And how is it then broken down into depreciation? Have them explain it to you. Have them go over the numbers page by page with you. And if it's explained at the fifth grade level, if you understand it, then you're okay. Be careful and understand kind of, there is something called a Dunning-Kruger effect. You can Google it. It's actually pretty powerful. It's basically a graph that shows confidence on the vertical axis and time on the horizontal axis. And it talks about how different professionals, and it definitely applies to accounting. I'm not sure about other professions, but definitely applies to accounting, where the graph goes up sharply, kind of the confidence shoots up as soon as you get into a profession, and then it kind of goes down to where, oh my God, I don't know
Huh,
anything. And then
huh.
it recovers back kind of, but it never reaches that first confidence peak. So beware of people who are super overly confident without explaining why they're confident.
Right, especially like early on, right? Where it's just like, oh, I got my license, so therefore I'm ready to go. Gotcha. Okay.
Yeah.
Those are some really good ideas to even find that, because here's then kind of that second piece to it. And I want to dive into this for a minute. People in the United States, we can do our own taxes. For somebody that has just maybe one, maybe two rental properties, even in their own name, should we be getting and hiring accountants? Or should we just be okay to do our taxes? Hey, I have a W-2, my husband has a W-2, we own 1, 2 properties. They're in my personal name. I could just do this on Turbo Tenant, can I?
Well, you probably could. I mean, there are bookkeepers who want to do business taxes, and that's a different conversation. But I will tell you that before I became a CPA, before I became a tax whiz, before I became a tax planner, my husband used to do his own taxes before we got married. Even my husband has used to do his own taxes in TurboTax, I think. And by the time I took over, which was about 2010, 2011, I believe he already had 2 properties rented or so. I can't remember. It was 1 or 2. And I looked, and somehow he was used TurboTax. Somehow he missed, or TurboTax missed, asking him for depreciation. So he wasn't claiming depreciation for about 3 years. The problem is that when you sell the investment property, you get recapture tax on depreciation whether or not you depreciated it. So if you didn't, it's your loss. You should have done it.
Right.
And so it's called allowed or allowable depreciation. It was allowable. He didn't claim it. So he didn't get the
Mm-hmm.
benefit from it. So, he was losing probably, I think it was like about maybe 15K a year in losses
Wow.
just because he didn't. So like you have to know a little bit more, I would say, to
Right.
use TurboTax, because you need to know what to look for on the back end on the tax forms when they come
Correct.
out.
Correct. Okay. So like that. So, and then there's a big kind of difference between like, cool, it's April 14th. I need somebody to file my taxes versus somebody that really understands tax strategy and kind of planning throughout the year. Can you just give us just like high level difference kind of between those two things?
So typically, traditional accountants work with about 916 people on average.
Wow.
And this includes one-person firms. We work with a lot less, a lot less. And the reason is that it's a typical, you just have to understand the psychology of accounting service. The trajectory is getting more and more and more clients to get more and more and more revenue, to get more and more independent of one client leaving or a few clients leaving, because you can always replace them, right? Like when I was a staff accountant, I could comfortably do, working 40 to 60 hours a week, 165 tax returns. If somebody who has their own practice and it's them and maybe another assistant doing 300, they work 80 to 100 hours a week. And then think about what kind of quality of service they provide to you.
Right. I was gonna say, by the time we get to the, I do not want to be tax return 315, right? At the end of that,
Exactly.
numbers are going to start to blend together and, people are going to, at the end of that week, I don't want to be that person at all.
Exactly. But you have no control over that. But then when you also think about this, if let's say, even if somebody has 400 tax returns to do, they do not have 5 minutes to think about how to help you save money on tax.
Right.
So that's the difference between a preparer who's just volume based, getting as much numbers on the form done, versus somebody who's a tax strategist. Somebody who's like me, a tax strategist, what we think about is, how do I help this client pay less tax? What can we do during the year? Tax planning doesn't happen in March. Tax planning happens before the year is over, because once the year is over, for this year, there's nothing I can do for you.
Right.
I mean, we are a proactive firm. We typically are done with our tax season on March 31st, roughly, about, plus or minus. And typically I'm already on vacation in April. And this next year is going to be the same thing. But typically we don't spend hours and hours planning for you once the year is over. There's no point in that. So we have clients, we get a lot of, people start thinking about taxes in February, March, and April, like you said. When we get clients who want to do some tax planning, if they want, we do the compliance piece for them. We file their taxes, whatever. But then we say, okay, in May, we'll talk about some planning. Don't wait until it's November or December to do some planning, because honestly, certain things for restructuring, December is already too late. Even November is kind of pushing it.
Right. Thank you. Say that again. Ladies, do not wait until the new year to start thinking about tax planning. In the new year, all you get to do is file taxes for what's done. So whenever you're listening to this podcast episode, start thinking strategy today, because you have to get ahead of it. I think that is so important. So when you then are kind of putting together that like tax strategy into not just filing your taxes, but actually adding in this strategy. And this, what I find so interesting is, this is one of the reasons that we hear lady landlords start buying rental properties in general, is for the tax benefits. In your opinion, what is the best benefit, the single best benefit to owning real estate when it comes to taxes?
Depreciation, 100%.
Okay.
Depreciation, just so that everybody's on the same page. Because I remember when I learned depreciation in college, our professor couldn't get 30 people to say what depreciation is. Depreciation is allocation of cost over the useful life of an asset. What that means is that you bought a home, single family home, for example, for 500,000. You don't deduct 500,000 in year one. You allocate that cost over 27 and a half years. And every year you take a piece of that allocated cost, which basically is depreciation. Depreciation, the beauty of it is that it's not a cash payment. So you don't actually have to pay anyone to get the deduction for it, which is a beautiful thing. Because typically, you spent money on repairs, you have to pay out of pocket, and then you get a deduction for it, but you spent the money. Depreciation is a non-cash deduction, which basically means that at least for the first 5 to 10 years, you will be showing tax losses while staying cash flow positive. So it's the best of both worlds.
Right.
That is created by depreciation. Also, depreciation has different things like bonus depreciation, which I'm hoping is going to come back at 100%, which means that when you buy property, 500,000, same scenario, buy in year one, you hire a specialized firm, and I would say hire a licensed firm, some firm that has an engineer and a CPA together. Hire that firm to do what's called a cost segregation study. That's how you'll, let's say, could potentially deduct 100, 150, $200,000 worth of depreciation because certain costs will be assigned to sinks, mirrors, toilets, and all kinds of things that could be detached and could be depreciated quicker. And so the benefit is that you get to reduce some of your ordinary income by these higher deductions in the year that you buy the property. Cost seg could be, I mean, we could do another episode on just cost segregation studies.
Right.
But cost segs could be done retroactively. If you've put a property in service in 20, you could still do it in 2024, 25, 26, whatever, years. You could still do that study retroactively and claim it in that year when you do it, not in the year that was placed in service, but in the year that you did the study. So lots of benefits from depreciation alone.
Gotcha. That's really helpful. And yes, we are going to have to do a whole different episode all about cost segregation and what that actually looks like, because that entails a ton of different pieces there. But that's really helpful because I feel like people are always like, oh, I'm going to buy rental properties for the tax benefits. And then they don't necessarily know how to implement that or really take advantage of it. So I love knowing that depreciation is one that's pretty high up there. What most lady landlords do think of, though, is write-offs, right? I know about anybody else that's out there that's also a Seinfeld fan. It always makes me think of Kramer, who was explaining to Jerry, like, don't worry about these big companies. They just write it off, right? And Jerry's like, what do you mean? Like, write it off what? And Kramer's just like, no, they just write it off. So talk to me about write-offs here. This is something that I feel like you hear people all the time like, oh, we can use this as a deduction. This is a deduction. Oh, we can write this off, write this off. Is there a place where taking too many deductions, writing off too many things can actually hurt a real estate investor?
I think so. You have to kind of put yourself in an IRS's agent's shoes. If that's okay. But I've had quite a few clients come to me and say, we really, really dislike the IRS. We really don't want to go to prison. I'm like, calm down. Nobody's going to prison unless you're committing fraud. So this is something to understand about the government agency. But put yourself in the IRS's auditor's shoes. The way it actually works first, before it even gets to an IRS agent, is when you submit your tax returns, they get analyzed by mainframe, by a supercomputer. And that's why for every business, there is that NAICS code, which is a 6-digit number that tells the IRS what kind of business it is. So the more precise you can get, the better, because the less chance that you will get potentially pulled for review. So let's say for a rental in that zip code, whatever your zip code, the rental income is too low. Let's say the supercomputer flags that. You don't even know that this is going on, by the way. You just basically just think that they're processing your return. But let's say the supercomputer pulls it for a manual review. Then somebody gets assigned to review that return manually, and they look for all the disclosures, which is why, when we work on returns, any sort of questionable thing or anything, we put a disclosure in the back so that if it ever gets pulled for manual return, they see, oh, they've already explained it. That makes sense. Thank you. And you don't even know that this happened. So you've just been kind of pre-audited, and they decided, this makes sense. They put your file back into the mainframe, if you will, and that's it. And you don't even know anything. But then if you don't disclose, if you're not upfront, then they might say, okay, you know what? We need to look at this in detail. And that's when you get pulled for a correspondence audit. Most audits are through mail. You get a notice, request for documents. It's called an IDR, information document request. You submit it, and then you go back and forth with the auditor. Sometimes you get invited to the office. That's kind of the third level of this.
Which sounds so nice, but it's really not the invitation you want.
Not really, no. And honestly, and that's where people sometimes laugh that I talk about this a lot, but that's where the importance of well-done bookkeeping comes in, because I had a client, we generally speaking don't have clients who do their own books or have their own bookkeeper. We maybe have 1 or 2 or 3 where there is a PM that writes checks and she does sort of the bookkeeping and we do the oversight of that. And sure enough, last year, I think it was, I get a notice because I'm a power of attorney on most of those. I get a notice that they're getting audited. And I'm like, I know exactly why they got audited, because they put this other expense on the tax return. And as soon as they see miscellaneous, other, sundry, something else, this is like, okay, let's take a look and see what that is. Right. So you have to be more specific. Large travel expenses also, same thing. They don't like it. So for businesses that are not real estate, we split travel into airfare, hotels, taxis, so that there's no one large item that is questionable.
Right. So it's not just like one big vacation, which was actually Disney World, right? It's actually really kind of itemizing like what part of that and then therefore why it was business oriented rather than family vacation.
Yeah, the more
Gotcha.
detail, the better. Less other, less miscellaneous and things like that. But also think about for real estate specifically, think about it this way. I just recently reviewed someone's tax return and every one of their properties had a coaching deduction for $7,500.
Okay.
And I and I was like, how much did you spend on that coaching? And she was like 30,000. I'm like, okay, I would put that on. So basically the preparer split the 30 between whatever, 4, 5, 6 properties or whatever that was. I was like, I would maybe not call it coaching. I would maybe call it education conferences, maybe marketing and maybe some combination. Maybe I would have split this into different things depending on what you were getting from that coaching. Because generally speaking, the rental income and law and expenses are reported separately for each property. It's a Schedule E, or for businesses, it's 118825, where every property is listed in its own column. And you can have unlimited columns like that. And so typically like meals, car expenses, and things like that are frowned upon. But at the same time, if you have proof and if it's a legit expense, I would absolutely put it on, even risking an audit, honestly, because if it's a legit expense, there's nothing you should be afraid of.
Right.
So, coaching was real estate related or whatever, similar to maybe what you do, real estate related coaching, great. It's going to help them make more money in real estate. The United States has always been known in supporting real estate and businesses and manufacturing. So real estate is one of those things. Why not, if you really paid for a coaching to buy more properties, to make more money? Absolutely allowed. So in general, it has to be a reasonable expense. A long answer to your short question.
Right. No, and that does go. Yes, Lady Landlords, the Lady Landlords mentorship program does actually get that benefit. We are that coaching program for exactly that, to help people be able to scale their portfolios. And that is something that's very nice to be able to use in that sense. But you just then tipped the iceberg here on a very, very big debate that we have within Lady Landlords, which is, should rental properties, in your opinion, be in LLCs? Or if I only have 1 or 2 properties, can those be in my name? Is that okay?
Generally speaking, it is okay if you have 1 or 2. The reason you wouldn't want to, there's a pro and con, big pro and con for that. The pro is that you get to have liability protection. So somebody falls on your property or breaks something or something, I don't know, what are those white ant looking termites
Termites.
eating your,
Yep.
like somebody eats and somebody falls into a hole, God forbid their injuries or whatever liability extends over your insurance protection, that person could go after you personally in your personal house and your personal car and things like that.
Right.
Not an ideal scenario. So that's a big pro of putting it into an LLC. A big con of an LLC is that when you do, it's considered a commercial property, meaning it's a commercial loan from the bank. And it's generally speaking is going to be at a high rate. However, there have been always banks that match the individual rate with the rental rate. So for residential real estate specifically. So it's just more about, do you look for a bank that does that so that you can actually benefit from that and protect yourself with an LLC? I think it's both can exist. I'm a big fan of kind of keeping your liability. I also think that, once you grow past 2 properties and when you have 3, 4, 5, 6 and growing, it makes sense that all of them are within the LLCs and potentially owned by a holding company so that you can benefit from a real estate professional status.
Interesting. Glad you said those words, because that is something else that pops up. But I want to ask one question first. So now you're talking about, now I have, 3, 4, 5, 6 properties. Now I have a bunch of LLCs, right? Now I had to take out loans to purchase them in the LLCs to best protect myself. Great. We want to do that. We want to be able to protect ourselves. But I don't want to now manage 6 different business accounts and checking accounts and credit cards. Doesn't that now make my life so much more difficult and frustrating to do bookkeeping, right? Now I have to file taxes for all these different LLCs. I have to pay for those things. Then now I have bookkeeping because I have, 6 different accounts for all these different properties. Where is the line of how to not make that so cumbersome for a real estate investor? Or is that really just part of the job, part of the business of being a lady landlord.
It's part of the business, but it can also be a little bit more simplified, simpler, if you will, because I'm a big fan of separating into separate bank accounts simply because it makes the audit easier.
Right.
The auditors will always assume guilty and you have to prove that you're innocent, kind of. They assume if there is commingling of funds in the same account, they will always assume that this will deem everything personal, and then you have to come up with invoices and receipts and all of these different things to prove that it belongs to this business or that property or this property. That's something that you would want to avoid because that's a time suck and money suck. You want somebody representing you, the whole ordeal is just dragging on for years sometimes and not worth it. But you can simplify bookkeeping. You can by using a software that has a banking feed. Banking feed makes our job a lot easier. It makes it a lot faster and makes bookkeeping more affordable. I mean, I'm not opposed to having one file, one QuickBooks file, one subscription, for example, if it's QuickBooks. I mean, there's a ton of different solutions, but I think that the most probably strongest bank feed is within banking engine is within QuickBooks. Intuit really did a good job on that. But have a separate account for each property, and then you can designate that so that all the transactions in that account belong to this property. So it's easy to categorize that and shift things around. You don't have to guess. And if you do that on a monthly or quarterly basis, monthly, I would probably advise, then it should be actually very simple. I mean, you don't have that many transactions a month on each property. A mortgage payment, a property tax, maybe a repair or two, maybe HOA dues, whatever. But it's, a handful
Right.
of transactions. Like we're not talking about a high volume. So it actually is less complicated and cumbersome than you would think.
I agree with that. Thank you, because that is important. Like when you are a landlord, you're a business owner, and we need to really make sure that we're understanding and following best business practices. Now, let's spend our last couple minutes here talking about that real estate professional status. This is something that is really kind of does not pop up on the radar of a lot of lady landlords until they really start kind of diving into this. So, what is a real estate professional? Do I need to be a realtor to be able to take advantage of that? What does that mean and how can I use it?
So real estate professional status, the beauty of it is that you can deduct losses unlimited for your rental properties. And the losses, again, remember, are not cash losses. You're not actually losing money on it. You are just allocating that purchase price for that year. So on a $500,000 property, it could be, $15,000 of a deduction every year. And that would turn your profit into a loss potentially, right? But a real estate professional status allows you to be not limited by it. So it's a very lucrative status. It's something that you would want, but it's harder to qualify if you have a full-time job. Because the rules are that you have to spend over 50% of your work time in real estate, or at least 750 hours a year. So a typical 40-hour work week has, for the year, it's 2,080 hours. So think about it. It has to be at least 750 hours, or let's say if you work 40 hours a week, at least 1,040 hours a year, right?
Right.
Over 50%, 1,041. This has to be over. So it's up to you to prove it, right? It's up to you to keep track of your hours. If somebody works full time, it's going to be harder to prove that you mostly spend your time in real estate. And think of it this way. Let's say you work 60 hours every week, 40 of them at the full-time job, 20 you manage your rentals, you go repair stuff. I actually know people who do that. And some of them are in your group, by the way,
Right.
on Facebook. But think about it this way. So you have 60 hours in a week times whatever 52 weeks, 30 hours have to be more than 30 hours have to be in real estate. And they don't qualify because they just spend 20 out of the 60.
Right.
So you have to be working 80 hours a week, to be able to qualify for over 50%. Or it's a
Right.
part-time job. You work 20 hours, you work another 25 in real estate. Okay, that qualifies. That's why the easiest to qualify that is if you're a licensed real estate agent, because then you already every day deal with real estate.
Right.
But the license is not required. I have clients who manage millions of dollars worth of real estate portfolios, and they are not licensed real estate professionals. They don't need it because it's, their stuff is all over the place. It's not just in one state. Because typically when you get licensed, you'll get licensed in one state. But if you're working, let's say 20, 30 hours a week somewhere else making money, maybe you're a bookkeeper or whatever, and you're deciding to switch to real estate eventually, then having a license could tip the scales in your favor. If everything else is equal and you have a license, okay, you actually, you know what, on weekends, that's 16 hours a week, I'm showing houses and things like that. So it's easier to qualify that
Right.
way. So, but it's not required. Absolutely not.
Gotcha. And once again, it's also not something that you have to like apply for. It's really something that you have to be able to document your hours. And then once again, it sounds like it's in the eyes of the landlord to at least kind of say what those things are for that hour, right? I had an open house. I had to go review applications. I had to go do
Yeah.
a move-in checklist. I had to go get keys made. Like all of those things, we need to be then tracking our time to really kind of show what it was that we spent our time on.
Just think about it this way also. If you hired a management company that's supposed to manage your property, then you can't use those hours, right? So like keep that in mind too. So it's not just like
Right.
one test that the IRS uses. It's a combination of different factors that may or may not tip the scales in the real estate professional area.
When you do qualify and when you show that you are that real estate professional, what benefit does that give you on your taxes?
So generally, most people who have a few properties and rent, they are limited to $25,000 of loss combined from real estate. So let's say you have 5 properties, each property generates $6,000 worth of losses, 30,000 total. You cannot deduct anything outside of 25,000. So the other 5 get suspended and carried forward indefinitely until you either sell that property or whatever. Real estate, and that actually gets phased out if your combined family income is 150,000 plus. So really you lose the benefit of real estate if you make quote unquote too much money. It's not too much money, but if you make too much money. But then qualifying as a real estate professional status, that allows you to take unlimited losses. So 30,000, you take 30,000 and you offset your spouse's income, for example, and that lowers your tax. So you get a refund or something.
And that also does not have that salary cap?
So there's no limit. There's no salary caps. There's no limit at all when you're a real estate professional.
Right. So that helps in a lot of situations where if you are in a situation where you're investing with your partner and one happens to be a high income earner and the other person is really focusing all on real estate investing, right? That would be a fantastic situation. And if one person then that's focusing on real estate can actually then qualify as that real estate professional, and that's going to make a huge difference for a household for the other person that may be that high income earner. So
That's exactly what we do. We focus on real estate because it's a standalone great way to save money on tax, but it's also a supplement to somebody who's a high earner, who's a doctor, an attorney, or architect, or whatever, who make money professionally on and don't really get some of the other benefits, but can benefit from the real estate losses.
right, which is the whole point, once again, of why we're investing in real estate, keeping more money in our pockets. Awesome. Last question I have for you then is what is the one tax benefit that you feel that you just wish that more real estate investors knew about?
So this one specific is less of a financial, but more of a much lower risk of audit. That is, I think, is my favorite. And it's also important because audits cost money and time.
Right.
It's having a holding company. Because when you just have properties owned in an LLC, there are certain benefits and certain liability protections that you enjoy. And then if those LLCs are owned by just another LLC as a holding company that is not a separately reported entity, so it's not a partnership, it's not an S corp, then it doesn't actually show up anywhere in your tax return. The problem is that if you have these expenses, like you have the mentoring program, you pay for all kinds of different things, when you report this just on your personal return along with your rental properties, you are at a 10 times higher risk of audit. So when you have a holding company, that's about a point. As of 5-6 years ago, the rates of audit were 0.34 for entities that report a business return, separate return, versus 3.4 on when you report these activities on your personal individual return.
Wow. That's a huge difference.
Yeah.
Huge
10
difference.
times.
And that also will then help with those that are building those portfolios and also having multiple properties, multiple LLCs, multiple accounts. That's why that holding company is so important.
Yeah.
Awesome. Tatiana, thank you very much. This was hugely informative. I know we have so many other topics that we can dive into, but we're going to leave it here today. So thank you very much. I appreciate your time supporting not just me, but all of our lady landlords here.
My pleasure. Thank you.
I will make sure for any of our listeners, if you want to reach out and connect with Tatiana, check down in the show notes and you can actually get all of her contact information there and schedule a time to speak with her. Otherwise, please also do make sure that you go hit that subscribe button so you do not miss the next episode of the Lady Landlords Podcast. We release new episodes every single Tuesday. And also, if you enjoyed today's episode, and I know you did, please make sure to leave us a 5-star review. Reviews help other women be able to find our channel and our community and get the same support that you get with building your portfolio. Thanks so much, and see you next week for the next episode of the Lady Landlords Podcast. Thank you for listening to the Lady Landlords Podcast. If you're feeling stuck in your real estate investing journey, visit lady-landlords.com to book a 15-minute orientation call with me and see if you're ready to join our mentorship program. Or you can subscribe to our newsletter and join our Facebook group for exclusive real estate investing tips and offers. Invest with confidence. Become a Lady Landlord today.